Hey guys, I want to talk through the tumultuous week that was with multiple banking failures such as Silicon Valley Bank, Signature Bank failing, requiring bailouts. We're talking about Credit Suisse requiring a $56 billion bailout from the Swiss National Bank. We're talking about First Republic requiring a $30 billion cash injection from various of the major banks such as JP Morgan et al. And what its effects are. Most notably, you probably see this chart right here. That chart is the chart that tells you everything about what's about to happen in the next couple of months. This chart is the 2-year Treasury notes. Now, that spike is actually the fastest spike in pricing in decades. That means the quickest drop in interest rates in regards to the 2-year Treasury note from the US government. Now, what this actually means is essentially we're probably going back into a low interest rate environment, or rather, you could even say money printing. That's on the cards again. And in this video, as we explore what these new lending and bailouts look like, we're going to be seeing how this could turn out to be a very massive level of money printing, liquidity injections, and what it might mean for your own savings, whether we might see hyperinflation. Let's get into it. Now, this chart, as you know, is the 2-year Treasury note. We're seeing interest rates basically drop. It's opposite to interest rates. When this goes high, it means the interest rate on that is dropping. So this is what Wall Street is thinking right up to now. Now, when we compare the 2-year to 10-year, this is the chart of the inversion, the yield curve inversion, the 10-year interest rate or return versus the 2-year. And every single time it's gone under zero, that is, the 10-year bond provides a lower interest rate than the 2-year, or rather the 2-year provides a higher interest rate than the longer term bond. We see an inversion, it goes under zero, and it means the players in the market think at some point in the future we're going to see low interest rates, maybe in around the 10-year horizon. Now, that means that we're probably going to have a recession between those 2 years to 10 years, and that's why we're seeing the difference go negative. And it's proven to be a great predictor of recessions. The gray parts are recessions, and as it slips under zero and the yield curve becomes inverted, we're seeing the Wall Street bet that something's going to change the interest rate regime between the 2 to 10-year mark, let's say, some medium length future, and we're going to have low interest rates. Now, we've been seeing that for a good since around June 2022. So the smart money has already theorized that we'll have some sort of recession. Now, what's dangerous is that once this starts turning back towards zero and back to normal, it usually means that the 2-year note, the 2-year bond, is going back to a lower interest rate relative to the 10-year, right? And that's what we're seeing here. We're seeing a 2-year. This is the fastest rate of the interest rate dropping. I don't want to sound too confusing, but when this pricing goes up, it's actually interest rate dropping very dramatically, and that's the fastest drop in decades. I think in 40 years, it's the fastest rate of increase that we've ever seen, right? So that shows you what sort of emergency we are in. We are really in the first week of whatever we're about to head into. We are literally in the first innings, and I know friends that go, phew, it's all good. The government has saved the day. But from what we can tell, if we're in the first innings of something that can be, repeated in multiple banks across the US economy as well as globally now, we're seeing with Credit Suisse, then certainly there is more to come. Now, how did they get bailed out? That's the real question. And how much did they get bailed out? Well, with Silicon Valley Bank and Signature Bank, Federal Reserve opened up a lending facility so that the banks with the sort of toxic assets, the money losing assets, can just drop it into the Federal Reserve. I'm speaking very simply, and the Federal Reserve will give them assets at the full price that they were before they dropped in value. And so this is so really in that process, we're only supposed to make good on a few tens of billions of dollars. I mean, Silicon Valley Bank was less than $50 billion down, with that facility. Signature Bank was also very little, but given the opportunity for the banks or the major banks or any banks to deposit the stuff that was lower in price, right, to get back loans that were at full price so that they wouldn't be underwater, the banks in 1 week took $150 billion of this loan, right, of this lending program, which essentially swapped the bonds, the loans that were worth much less, right, because of the high interest rates, for bonds that wouldn't have, in theory, be affected by it. So, 160 billion, and that, it might not seem like much, but this actually plays a lot into the risk of what we might see as hyperinflation. Now, all this money for bailing out $160 billion, that isn't little money at all. And I want to put that into context of how much that truly is, $160 billion. Right now, we're printing so much money like it's going out of style, but it's still a lot of money. Let me show you exactly how that is. Now, as we were raising interest rates from about mid-2022, the Federal Reserve actually had about nearly $9 trillion in assets on this curve, right? So this is the curve since early 2021, but it'll keep, if we go back into the history since 2020, it was far less, right? We've been increasing the amount of loans and money being injected into the economy. And as this has been happening, we realize, or the Federal Reserve realized that, hey, we've got too much inflation. Let us take out the money, raise the interest rates, make it a little bit more difficult to do business, so it slows down the economy and hopefully slows down inflation. Now, as we see this dip, this is hard fought, right? We had nearly $9 trillion. I think that's $8.9 trillion on assets on the balance sheet for the Federal Reserve. And at the lowest point, just before this craziness of Silicon Valley Bank and all these banks collapsing and the bank runs, it went down to 8.3 trillion. So we've had about, March from, let's say, approximately May. So that's about 10 months. It took us 10 months to cut this balance sheet by 600 billion, right? And there's a lot of interest rates. This is what they call QT, right? Quantitative tightening the financial conditions, tightening the liquidity. We took 10 months to be $600 billion down. And it's not just this $160 billion lending facility that the Federal Reserve created. They've actually injected something to the order of $300 billion, $297 billion. In 1 week, we took 10 months to get $600 billion down. And within 1 week of this, potential crisis, you could say, we've erased that money tightening by $300 billion. Half our work, 10 months of work, has just been erased in 1 week. You might be thinking, well, maybe if we have a second week of this happening, these issues, this crisis happening, or third week, we overshoot that probably by week 2, right? Now, I don't know what's happening next week. I can't predict it. I'd say probably it's not as intense, and there'd be a lot more programs to calm the markets down. But let's just say we go on the same trajectory. By the end of next week, this would come back to 8.9 or 8.8. We're back to square one. Before all the interest rate hikes and before the quantitative easing, all our work for 10 months would be undone, right? And let's just say simply say that's the case. It would be a couple of weeks. Now, what's really interesting is that JP Morgan, they're pretty smart with with everything in the economy. Let's just go with that. Now, what they actually said is that they expect this to be $2 trillion, the amount that's required to stop the bleed of the financial system. $2 trillion, right? We spent 10 months trying to cut back on $600 billion. 1 week to give that half of that away, and now we're going to print more. We're going to print $2 trillion more into the economy. And guess what? We have an inflation problem, right? And we're going to print another $2 trillion more. So yeah, the JP Morgan, the analysts there, believe that we will inject another $2 trillion, right? We just injected 300 billion, right, in 1 week. So they're not too off the mark. I mean, that's not too crazy or unreasonable in light of the last week. And so the real question is at this point is what's going to happen to our money supply. And by the way, one more thing, right? This is an article on Market Watch. Academic study flags that 186 banks as vulnerable as a run as Silicon Valley Bank was. We've got 180 banks in the US that are in the same situation and that will probably require a bailout. And I suppose this is which coincides with that study. They concluded that we need $2 trillion of assets there's a $2 trillion hole that needs to be plugged so this whole thing doesn't collapse on itself. So right now we're sitting on what looks like a rock and a hard place. We've got inflation that's happening, probably the fastest inflation in over 40 years since the 70s. And some argue that it's more than what was happening in the 70s and 80s, right? We're doing really dodgy ways of calculating inflation. I mean, I look in the supermarket, everywhere I go, we're talking around 20% inflation. But the news says it's under 10%. I mean, come on. I mean, it says it's like 6-7%. I'm like, if that was actually the level of inflation, I'd be happy with that. But it's not. I had a friend. He was paying $1,000 with 2 other housemates, $1,000 a week of rent in the inner city. And they're raising the rent to $1,400. That's a 40% increase. I mean, that's happening. I got another friend that was only a few months ago. The same thing. We're talking about 30% increase, give or take, right? That's happening to many people I know. How can it only be 6% increase in inflation? It's preposterous. So the way we're accounting for it, I mean, we're having a inflation level higher than we've ever seen in history, in recent history, by a long margin. We are not taking that into account. Let me just say it's BS. And I don't know if YouTube likes it when I say this sort of stuff, but it's absolutely true. It's absolutely BS. So the real question is, how do we prevent, how do we sort of protect ourselves from the situation? Now, the other chart I wanted to bring up, not just the 2-year Treasury note, the bond, right? Which, provides interest, and we think it's going to have lower interest rates. Now, the real telling sign, I think, this week that panic has sunk in is we're looking at assets like Bitcoin. It's gone up 9%. It was only $20,000 only a week or two ago, and now it's jumped up to nearly 27,000. I wouldn't be surprised if it jumped up to 30,000 within short order by the time you watch this video. So this is another concern. I never looked into gold for a couple of years. I was very much into it when in the early 2010s. But let's look at gold for a moment. What's really happening with gold? We've had an absolute pop, and this was happening since this was the Thursday before, the day that Silicon Valley Bank got shut down, and then the Friday trading day, Monday, Tuesday, Wednesday, Thursday, Friday, bang. I actually thought that it would drop down a bit. It would drop down a bit before it went back up. No siree. And even with the interventions from the Swiss National Bank, $56 billion to save it. We had interventions from JP Morgan and other major banks, and with First Republic, we've had the bailouts, so to speak, with Signature Bank and Silicon Valley Bank. So no one's lost any money, but gold's saying there's a problem. In fact, just going back into the 2-year bonds, they're saying, everyone's piling into the 2-year note, thinking we're going to have lower and lower interest rates, right? So if we have lower interest rates and inflation's running hot, I mean, where else do you go to protect your money? Because you're not getting a good interest rate to counter inflation. So you might as well buy something that's a commodity that keeps up with the inflation. Now, I was thinking a few weeks back that maybe in a high inflation environment, we have something like gold or oil. Now, I'm going to finish off with this chart really. And this is the most concerning chart. We've had a number of concerning charts. I'll just show you this video. But this one, it truly is. And this is the price of, drumroll, oil. And oil has absolutely crashed through the floor. Right now, oil is a commodity, and in low interest rates or high inflationary environment, it usually goes up, right? So there's still the specter of high inflation, and I'm still seeing in the supermarket. Don't get me wrong. And are you guys seeing in the supermarket? I'm definitely seeing in the supermarket these days. Now, what's with this crash? We'll just see. Let's go back track. So on Wednesday, it was already dropping a little bit. Now Thursday with Silicon Valley Bank, the smart people in Wall Street, you could say, figured out this is probably going to lead to a recession, lower demand, even in the low interest rate environment, right? Even in the, something that's inflationary, we're having lower oil prices. That's what Wall Street believes. Friday, what is it? This is Tuesday, sorry. No, my apologies, guys. So Monday, we worked out, or the Wall Street worked out, that we're probably going to head into recession. Tuesday, Wednesday, Thursday, and Friday, there's no recovery yet. But we're seeing rumors of low interest rates from, I think, Wednesday, Thursday, Friday on. The chatter about how maybe we might start printing money again is kicking in. So this might get a little bit of a push up. But from what I can see, I think the Wall Street is pricing in a recession. And we're talking about lower interest rates, but it's being priced in by the 2-year notes. By the 2-year notes, we're having lower interest rates. Remember, it goes opposite. When this goes up, interest rates go down. Let's have a look into, by the way, the 10-year note. I expect to go up to, it's going up. So if that's the case, and we need money to save the day, I think the bonds is a good place to buy. It's going to keep going up. And this is what Wall Street thinks. We're going to have more liquidity coming in despite high levels of inflation. In fact, perhaps inflation is going to go because we're seeing the price of oil dropping. So maybe we're not going to have inflation coming up. We're going to have deflation. So what do you guys think? Are we going to have deflation from this potential recession that we're going to see? Or are we going to see inflation, as we were talking about, with gold going up, with all the money printing that's happening already, the potentially $2 trillion of money printing, wherever it is. So you've got 300 billion coming in. We've got JP Morgan saying we're going to need 2 trillion. Is that what's going to happen? Some combination of both. Let me know what you guys think. I'd love to hear comments down below. And if you like the video, please hit the like button and share with your friends if you think you have friends that are interested in this. And subscribe if you haven't. I really appreciate your support. I'll see you guys in the next one. Ciao. Take care, guys. Bye.